All right, guys. Good morning. Good morning. Or wait. Is it still the morning? It's technically, I'm in Texas. It is not quite the afternoon yet. We have the FOMC decision going live at 2 p.m. Eastern Standard Time. This does include the summary of economic projections. And yeah, we got a lot of stuff to cover, honestly, today. We do have the summary of economic projections and more going live in a little bit over an hour. You can check out our fancy new background here that we're using. And yeah, it's a big day. You know, we went ahead and put a list of all the voting members during this decision at the top of the screen. You can see it regarding where they stand, whether they are a dove or a hawk, and everything in between. We have a rate decision countdown. You can see the rate decision is going to be going live in about an hour and 8 minutes. The presser is going to be in about an hour and 30 minutes, a little bit over that. It is widely expected that we are going to hold rates steady. In fact, it is 99+% likely that we are going to hold rates steady today. During the January presser, we had Moran dissent and Waller dissent. Remember, Powell's term does end in May, and Kevin Warsh is supposed to step in if they confirm him, but the recent kind of rumblings there is that they're not going to confirm him. We'll see if that changes now because of the subpoena being dropped. I think the Department of Justice, regarding the Fed building subpoena by the Department of Justice against Jerome Powell, I think they dropped that, but I think they're appealing it. But if that doesn't go through, maybe they'll confirm him on time. But yeah, we have the FOMC decision today. It's a big day. Let's see. I tried to put this chat overlay thing up. Let me see if I got it working here. But yeah, it's in about an hour from now. In about an hour from now. Yeah, good afternoon. Market's down in 10 seconds. That's right. Hey, that's how it happens. Sometimes it really is. You can see the S&P 500, man. It's sideways, really. I kind of expected chop today. I kind of told the stream this morning. We had a lot of downward pressure from PPI inflation showing up noticeably hotter than expected. So we did have some downward pressure from that. But since the bell, we've been sideways. And I think some of the best days to attack sideways choppy trends are during, they're during the Fed meeting, right ahead of the Fed meeting here. Jerome Powell, hey, what's up, man? All right, where's my countdown timer? We got the chat overlay. We got too much stuff going on. Let me know if you like this music. I can always change it, but yeah. So far today, again, what's the big story of the day? There's two main stories. We talked about this earlier. Two main stories today. The first one is going to be, what does the summary of economic projections say? What is the outlook looking like? Where are people voting on how many rate cuts we get this year? That's going to be front and center today, is the summary of economic projections. Now, this releases exactly at 2 p.m. Eastern Standard Time in about an hour. And so every 6 weeks, they do the FOMC decision. But every other decision, we get a summary of economic projections. So it does not happen every meeting. It happens every other meeting. We get a summary of economic projections. And so we'll see what we get today. We'll see what we get. And yeah, I don't know. I really don't know what we're going to get today. Hold on. Let me turn this on. Make sure we start getting some of these comments here. But let me know what you guys think we're going to get today in terms of the summary of economic projections. I'll ask the chat a question here really quick. How many rate cuts do we think we get in 2026? I asked this earlier. A lot of people said we'll get 0 rate cuts in 2026. I can see Pew here saying, let me get this right. He said the last few recessions started right after highly increased oil prices. So the last few recessions started after highly increased oil prices. And yeah, oil, guys, right now, obviously elevated after more strikes happened over the weekend. Oil, even since the opening bell, has pushed up some. Although, if we take a look at it back here, oil has retraced back down to 96.80s right now, 96.80s. So, Yeah, we'll see what we get. I see some people saying 0 rate cuts this year. I see Good Husband saying 2 rate cuts this year. We will see which one happens. But oil at $97 a barrel for Brent crude. $97 for Brent crude. Nathan says, I can't agree more with Pew. And here's the thing, right? Like, we got PPI this morning. PPI showed elevation in producer business inflation, which can sometimes, if it's continuous, can get passed on to consumers. You know, PPI inflation, if we take a look at it, PPI inflation was much hotter than expected. Much hotter than expected. Again, this is the second month in a row PPI was hotter than expected. This was both core and headline PPI higher than expected month over month and year over year for both core and headline PPI. So PPI did show up hotter than expected. If we take a look at the NASDAQ this morning here, the NASDAQ, S&P, Dow did react negatively to this as well. The data came out right here, right at 7:30, right here. So you can see the negative impacts we've gotten from this PPI print already. And again, this doesn't include the March increase in oil. So oil going up is going to make inflation worse. And oil over the last 3 weeks since this conflict started has been pushing here. So it's one of those situations where prior to the oil spikes and the inflation increasing aspect of the oil prices we're seeing now, prior to that, we had elevated PPI inflation for last month. And so with that, people are going to be nervous regarding when we're going to get rate cuts. I think it's going to push back the odds. If we take a look at yields did stabilize some. So if we look at 10-year Treasury yields did stabilize some. Although they're ahead of the Fed meeting, they're back up a little bit. They were closer to 4.2% today. But ahead of the Fed meeting, you can kind of see yields jumping up here. They're currently at 4.26% right now. 4.26%. You can see this number right here. 4.2 or 4.22%, 4.23% if you round up actually. And so yeah, yields are up. Today, they are up really over the last month, obviously, since the conflict started. Here's March, and then here's what yields have done. And yields and interest rate sentiment correlate. So interest rate sentiment is higher, yields go up. Interest rate sentiment is lower, yields go down. But you can see when March started here, and the interest rate sentiment immediately spiked up from this conflict. And so heading into the FOMC decision today, that's the big story. I think that's the big story heading into the FOMC is the oil surges that we're now seeing in everything, really. In everything. So let me take a sip of coffee. But yeah, I see people saying degens and oil. Are we ready for a crash? I don't know. Which is better, trades futures or options? It really depends, man. Everybody's different. It's subjective. Everybody's different. I wonder if Powell... Here's a good question. Will Powell comment on oil today? I don't know. I think he's definitely going to comment on some of it, and I think it's going to sound something like this. I think he's going to say, because of the increases in oil prices from the Middle East conflict, there might be... I think he's going to call it headwinds moving forward, but I think he's going to say there's more upside risks to inflation now because of the Middle East, Iran conflict. That's probably what he's going to say. He's going to say something like that. But again, like we don't know what he's going to say. We don't know what it's going to look like. We're going to get the statement at 2 p.m. So we'll get the statement at 2 p.m. And yeah, we'll get the statement. We'll get the summary of economic projections at 2 p.m. And then at 2:30, that's when the press conference starts. And so we'll get the outlook, really, at 2 p.m. by the summary of economic projections. And we'll get a little bit of it in the statement that they make. Like, they'll talk about inflation. They'll talk about the labor market probably to a certain extent in the statement as well at 2 p.m. Eastern Standard Time in an hour. So they'll talk about all that stuff. But we're really getting to see the big moves regarding all of this stuff in terms of, what Jerome Powell's tone is going to be like during the press conference at 2:30. So Powell was definitely not going to cut. I see somebody say Powell's going to cut. He was always a rebel. He definitely, he's not cutting. We're going to pause today. 100%. 99.9%, if that makes you feel better. But, yeah, let's do a poll here today. I have not done a poll here, so let's do one now. I lost my chat. Hold on, let me find it. Yeah, the dollar index, NASDAQ testing lows here ahead of this report. Look at the NASDAQ breakdown here. So the NASDAQ is falling 24,820s right now. Here's the S&P E-mini here. It's at 6720s. What if we raise 25 basis points? We're not going to. So if you look at this comment right here, somebody said, what if we raise 25 basis points? We're not going to. And so it doesn't matter because that's not happening here today. We are not going to be raising rates today. It's not even in the odds of the Fed watch tool. If you look at the odds here, let's take a look at this. If you take a look at the odds here, guys, there is almost no chance, we're raising rates. I'm not going to put the outlook at 0, but it's definitely not high. So here's the Fed watch tool. Now this might be from earlier if it is. Wait a minute, there is a 1% chance now of a raise today. I think it would shock markets. I didn't even know this. So they did change this. This changed over the past 3 hours here. There is currently a 1.1% chance in the Fed watch tool that we raise interest rates today. 25 basis points. We're currently at 3.5 to 3.75. But there's a chance we raise today, which is really interesting. This pivoted back from a 1% chance of a cut to currently 1% chance of a raise. And so you're saying there's a chance? Yes, there is about a 1% shot. It's still not happening. We're not raising rates today, but there's a chance. Yeah, there's a chance. Hey, what's up, Pawn? Bears Thursday and Friday. Yes, sir. Let's see what happens today. I was waiting on that. Yeah, I didn't even notice it switched, to be honest. So I didn't even notice it switched, but man. Yeah, the NASDAQ is dumping down here. I don't see anything big moving markets, really. I see... Okay, so there's a couple things going on right now. Let's talk about it. Number one, about 7 minutes ago, we got news that an Israeli official said the strike on the gas facility was coordinated between the Prime Minister's office and the White House, according to Axios. All right, you can see when this happened. 1, 2, 3, 4, 5, 6, 7, 8, about 8 minutes ago. That timeline makes sense. The official said it was aimed at signaling to Iran that if it continues disrupting oil supply through the Strait of Hormuz, there could be an escalation in the targeting of its energy facilities and worsening of the economic crisis in the country. It was a signal of what could come next, according to the official, reported by Axios. And so, escalation in the conflict, probably spiking the price of oil a little bit short term over the last, 1, 2, 3, 4, 5, 6, 7 minutes, up a little bit, and then the NASDAQ just dipping down some here. It also could be by individual stock movements. Like, we could get individual stocks moving down here. We'll take a deeper look at it. But here's Nvidia. Nvidia fell down heavy over the past 5 or 7 minutes as well. So Nvidia dropped. Here's the previous close. So Nvidia is about flat on the day. But airlines have a huge financial losses from flight cancellations tied to the U.S. conflict that began in late February. 23,000 flights in airlines, costing nearly $1 billion in lost revenue. My gold buy target is 4,400s. We will see, friends. We will see. But just be ready. It's the FOMC decision today, guys. I'm going to ask the chat again. How many times do we cut rates this year? Yeah. How many times do we cut rates? What's up? Zero? Yeah, no. I mean, I think zero is a possibility. I think a lot of people are arguing for rate hikes now because of the PPI inflation report that we got. And so, John, can you put a timer up? Listen, brother. Listen, man. There is a timer right next to this on the right here. There is a timer. It's in big red letters. It says rate decision, dot plot. The last two times we had Moran and Waller descent for a cut. And yeah. So again, the Fed decides interest rates today at 2 p.m. It's the single most important event in finance, really. Today, it's what's going to matter is going to be Jerome Powell's tone. Definitely 1 to 2 rate hikes. I don't know, man. What's the new Fed chair going to? What's the new Fed chairman going to do? So Warsh does come in as long as they confirm him, which is not guaranteed. But as long as they confirm Warsh as the next FOMC chairman, Warsh comes in May. But again, if you look at the top of the screen, like look up there, you'll see all the different voting members of the Federal Reserve, where they stand in terms of hawkishness or dovishness by them. You can see like Beth Hammock is generally a hawk. Lori Logan is generally a hawk. Neil Kashkari is kind of a centrist. Anna Paulson, which is the Philly Fed, is a dove generally. And so you can kind of see where the voting members stand. So even if Warsh steps in, and let's assume Warsh is incredibly dovish, he's still got a, he's still just one voting member. Like Jerome Powell obviously is stepping down in May, but Warsh is just one member. And so it's not like Warsh can step in and say, this is my Fed now, we're cutting interest rates now, and then boom, after May, the Fed meeting after May, all of a sudden we start to get cuts. It's just not how it can't go like that. They have to vote on these things. It's a, they have to vote. And so it's not something in which, it's not something that he could just step in and control things. He's going to have more sway for sure as the chairman. But yeah. Yeah, I actually thought a fly was on my screen just now, Mark. I was looking at my screen. So Ace Boogie says we're going to get 2 rate hikes, or 2 cuts this year. In order to get rate cuts, let's look at that scenario. In order to get rate cuts, what would we need? We would need a stabilization in oil, causing inflation to decrease. That's the number one. We need a stabilization in oil, causing inflation to decrease. That's the first thing we need. Number 2 is we need really weak labor data to justify the cuts. And so the Federal Reserve, the way they operate is their job is to maintain balance. They have their dual mandate. They want to, they want balance between the two is really what they want. They don't want labor getting too weak. They don't want inflation getting too hot. And so they have a couple tools they could use to kind of combat this. But if things getting excessively weak in the labor market, they can step in and they can lower interest rates. If things get really, really weak, they can print. They can print to try to get us out of it. They can do quantitative easing, which is where the Fed creates online money basically, and then uses that money to buy up bonds and expand their balance sheet that way, and other assets too. But they only usually do that in desperate situations. Examples of these desperate situations are 2020. 2007, 2008. I think they did some QE in 2020 and 2016, if I remember correctly as well. The problem with this is it's money printing, and it causes inflation in a much faster rate than just basic rate cuts. A lot of people argue that a 25 basis point cut or, small rate cuts are not going to spike inflation at the levels at which people fear. And that really printing and hyper easing is the villain in terms of inflation. And I wouldn't necessarily disagree with that. I think Warsh also kind of mirrors the same tune where Warsh is okay with rate cuts, but he doesn't like QE as much. And again, I kind of agree with that aspect of it. So We also have seen GDP turn here, guys. So we've seen GDP fall. You know, the last GDP print that we got was from the last GDP print we got was 0.7%. It was the first revision. So the way you get GDP data is you get it every quarter. You get 3 different GDP readings. You get the initial estimate, which is the most variance heavy one. That has the most variance. You get the first revision, which is the middle one, and then you get the final estimate. All right, so the last one we got, I think it was last week, was 0.7%. The previous one was 1.4%. I think they expected 1.4%. It should have been 0.7%, 50% of what it was expected to show up as, and this is for quarter 4. And so GDP has seen a turn as well. We have seen GDP turn, you know, getting closer to negative depending on what the next one shows up as, but the next one is going to be the final one. And so if that one shows negative, look at the S&P breaking down here. S&P's at 67.15s right now. Spy's gonna puke. Yeah, it's definitely looking a little pukish. And again, we'll see. So just to recap the January meeting here, guys. Just to recap the January meeting. Right, let's talk about it. What happened in the January FOMC? Sorry, I gotta get some of this out the way. I'll move this up a little bit. But yeah, let's recap January. The Fed held rates steady in January. They paused interest rates. 3.5 to 3.75% is where they paused them at. There were 2 dissenters. Waller and Mirren dissented. They wanted a 25 basis point cut. The committee said the job market showed, quote, some signs of stabilization. So they did say we saw some signs of stabilization during, you know, that period. One of the things and one of the big talking points, I have to change this song. I'm sorry. I feel like I'm in a Disney movie right now. Okay, that's better. Yeah, one of the things that we're seeing here is that most of the members agreed that they were going to hold rates steady for some time. And this is before oil spiked up at the rates we're seeing now. Here's the S&P still breaking down. Here's oil. But most of the members agreed that they were going to wait and see, basically, during the last FOMC meeting. They said, we're going to wait and see what happens. And yeah, I think we're going to continue to see that. If you look at the odds for rate cuts, like going back to the odds of rate cuts here. We can take a look at this. Looking at the odds. Let me get rid of this real quick. Hold on. Yeah, looking at the odds now, there's now a 1% chance of a rate hike. In April, 97% chance of a pause again, a 1% chance of a rate hike in April as well, and a 2% chance of a rate cut. Moving over to June of 2026, still a 0.9% chance of a rate hike by then, 82.5% chance of a pause, you know, and roughly 16.5% chance of some cut by then. And so really, it's not looking like we're going to cut interest rates as of now until the majority outlook for rate cuts doesn't take over until January of 2027. And so these have changed recently, but these are all the odds of a potential rate cut right here. And we still have a 0.4% chance of a rate hike. But now it's looking like we're not going to get any rate cuts this year if we're looking at the odds. And this is from oil spiking where it's at now. You can see oil moving in an elevated way over 97 as we speak here, over 97. So we will see if this continues. If I were Powell, I would hike now. And yeah, we'll see. Chat, we'll see. We're getting close. We're getting close. Oil elevated here. We had some breaking news ahead of the FOMC meeting, and we're going to stream the whole thing live at 8:30 Eastern Standard Time. So, the U.S. national debt has officially hit $39 trillion as well. Yeah, it's time, guys. It's time. We have the Iran parliament speaker saying, quote, "The eye for the eye equation has taken root and a new level of conflict has begun." According to the Iranian parliament speaker. Again, he said, quote, "The eye for an eye equation has taken root and a new level of conflict has begun." Going back to this is the Iran parliament speaker. Bahrain's interior minister did say air raid sirens are going to sound and citizens and residents are urged to head to the nearest safe place. But yeah, worried about more escalation here is driving prices higher in oil. NASDAQ, S&P, if we look at it, are falling down here. The S&P is under 67.20s now. It's at 67.19s for the S&P 500. What's up, Kato? Yeah, we have the FOMC decision going live in 45 minutes or so. But yeah, FOMC decision stream live. We were looking at markets though. Here's the S&P. We're at 67.20s right now. I don't know if this is going to hold. We'll see. But don't you think Warsh was only appointed so that he could bring more cuts? I mean, yeah, a lot of people thought it would be Waller or Hassett, the two Kevins. Or no, Warsh is one of the two Kevins. Sorry. People when Warsh was originally nominated, markets actually reacted negatively because the logic was that it was going to hurt rate cut odds. You know, Warsh historically has come out critical of interest rates. But yeah, Warsh has been critical of specifically quantitative easing. He's not the big hawk people expected him to, but when he was originally announced, the markets did go down here. So during the 2008 financial crisis, Bear Stearns had just collapsed. People were nervous, like the economy was in a free fall. Warsh told his FOMC colleagues that the inflation risks, quote, continue to predominate as the greater risks to the economy. End quote. So basically during that, he did prioritize price stability over a cratering labor market. RSM's chief economist called this a red flag, saying Warsh, quote, got the policy response wrong, end quote, and that his, quote, first instinct is hawkish, end quote. In September 2009, when the Fed signaled it would hold rates near zero for an extended period of time, Warsh warned that waiting to raise rates until the economy normalized meant they would almost certainly have waited too long and we'd get inflation spikes. On balance sheet, he advocates for a narrow central bank. He views the post-pandemic inflation that we saw after 2020 as a failure in policy. But, you know, I think Warsh being hawkish is low probability. You know, remember, though, Trump did appoint Jerome Powell. And then Trump obviously has been incredibly critical of Powell recently. And so Warsh did appoint Powell. And so you have to understand, just because the president nominates him does not mean he's going to do what the president wants. But at the same time, if the president recently interviewed him a ton, and if the president thinks he's going to be dovish, he's probably going to be dovish short term at the very least. It's not a guarantee, but you know, if the president really wants lower interest rates, I don't think he's going to appoint somebody that he thinks is going to raise rates or be incredibly hawkish for interest rate sentiment. I just don't think that's going to happen. Crypto news, the SEC declared most crypto not securities. Yeah, we can look at Bitcoin here. But all right, guys, be ready here. Wait, what am I forgetting? Oh, yeah. All right. This is different music than I was expecting it to be. We're at 67.20s here. Let me know if this is too loud. I can change it down too. I think it lowers when I speak. But let me look at our poll. Did we do a poll yet? I don't think we did. I have to find my chat. There it is. Okay. Will Jerome Powell have a hawkish or dovish tone during today's press conference? Hawk or dove? I'm going to add neutral as an option in this poll here just to keep it diversified. So will Jerome Powell have a hawkish or dovish tone during today's press conference? Hawk, dove, or neutral? Let me know. If you were a chairman, what would you do? So I see people asking me this a lot of the time, like, what would I do? If it was prior to the Iran conflict, I'd probably cut interest rates. But the Iran conflict does make it a little bit spicier to cut interest rates right now. As long as we don't print, it's still somewhat okay. But I'd probably, if I was chairman, I'd vote for a pause today. The Iran conflict, the prices in oil are going to cause inflation headwinds potentially, and so we got to wait to see what that looks like in the short term before we decide to go on an easing cycle or just one-off cut rates today. Looking at our poll, so we did the poll now. We're pretty split down the middle, or no, we're not. So 50% are say hawkish tone by Jerome Powell, 14% say dovish tone, 36% say neutral. I have a question for the doves out there. What's the argument for a dovish tone? I mean, I could give you the argument, but I'm curious to see what you guys say. What's the argument for a dovish tone today? Yeah, Saudi Arabia issues danger warnings for the governors of Riyadh and Al-Kharji. I see C. Johnson saying jobs. And I showed you guys this earlier, but if we look at this, NFP graph here, guys, so this is non-farm payrolls. It's not like it's a super easy decision. I think we're somewhere in the middle here. Here's the last 5 years in jobs. Okay, so if you look at the last 5 years of jobs, you'll see some things here. The first thing, hold on, I'm gonna have to reset my screen. It might go blank for a second. There we go. Yeah, so if you look at this, this is the last 5 years in terms of non-farm payroll data. And so people can say the labor market's fine, and I get it. But again, if we look at this, that's the last 5 years in trends in non-farm payrolls. And so the labor market, especially the last one, showed negative 92,000. We did get one mid last year. If you look at this, we did get one mid last year, negative 140,000 jobs for non-farm payrolls. And so the labor market is not necessarily in a great spot either. And so what we have right now, we have oil surging. It's at $97 a barrel right now for WTI crude, 97. We have weak jobs, and we have inflation risks and weak labor, unfortunately, right now. And so it's a little bit scary of a time, I think. Here's the S&P 500, still sideways ahead of the Fed meeting, but we're almost here, guys. We're almost here. Yeah, this is the labor market. And so it's not really like, it's not like the labor market's in a good spot either. If we look at a 10-year chart, it's a little bit like we had really weak numbers here during 2020. You know, you can see how weak the numbers were in 2020. But even if we zoom in here and just look at this trend, I wonder if I can get it the max. Oh, it wants me to pay for it. I'm all right. But you can kind of see, like, look, if you dig deeper here, let me see if I can zoom this out some. You can see the weakness that we're starting to see. You see the negative job prints becoming more and more frequent. Negative, 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 negative. And so you see the negative job prints becoming more profound over time. Stagflation might be on the cards. I'm long on Bitcoin. Go FOMC pump. Hold with a hawkish tone towards a potential recession if conditions hold to talk both oil and 2-year spread. Yeah, we'll see, guys. We'll see. Let's see what we get today. FOMC decision. FOMC decision. Let me make sure that we are... Yeah, we'll see what we get in terms of inflation, though, today, man. It's not inflation outlook by the Federal Reserve. How is going to be hawkish, man? The unpredictability of the conflict. No, I actually really agree with this. NY Mofo says Powell is definitely going to be hawkish. The unpredictability of the Iran war plus the data we've gotten thus far would give him and most of the Fed reason to be hawkish. Yeah, I expect a hawkish Powell today. Looking at this comment, I do expect a hawkish Powell today. I don't think there's much of a chance we get dovish Powell. You know, while the labor market's weak, I think we have hawkish Powell today. I think hawkish or data dependent and neutral and wait and see approach is what we're going to see here. So I think we're going to have sideways chop leading into this, and then I think we're going to have really a data dependent. I think the dot plot and summary of economic projections at 2 p.m. is going to be crucial. So we'll see what that looks like. But yeah. Fed might have to raise rates if this doesn't get better. No, 100%. Yeah, I think wait and see, Danielle. Or Daniel. I think wait and see is what we're going to see. No, I'm in the same room. This is my office. People always say it's a kitchen. It's not. It's a library, actually. You know? So. In a few months, raise. Do we see rate hikes this year? Another question for my chat right now. Do we see rate hikes this year? Dude, just pay the light bill. I turned the light on it here because it's the middle of the day. When I first get up in the morning, it's dark. So. Yeah, it's the same room. Look, there's the bull thing. It's the same room. Heck no, we don't get rate hikes. No. Yes. 1 to 2 hikes. I'd say neutral. No. You have an office in your kitchen? Hey, you know. What color will Powell's tie be? Another big question of the day. Will Powell have a... I'm going to go with purple, guys. I go with purple every time because he always wears purple. If he wore a red tie one day, markets would freak out. So I'm going to go with purple because purple is what makes the most sense to me. But let's see what we get. I'm going with purple. Yeah, it's all good. Baby blue tie? I think even a baby blue tie would scare markets, to be honest. I think. Mauve? I recently learned how to pronounce that. Prior to this, I had no idea how to pronounce that. Yeah, also, where are you guys from today? Where are you guys from? Watching this Fed meeting with me, I appreciate it. Where are you guys from? Let me know. Burgundy, my boy. Is it not mauve? I always said it was mauve. You know, but somebody told me I was wrong about that, you know. All right, looking at the chat. Mauve? So mauve is right. Arizona. I see some Arizonians. Australia. We got a lot of Australians in the chat. Jersey. Dubai. Be careful over there right now. Cali. Illinois, Bama. I'm sorry, but go Tigers. You know, I like Alabama, actually, but still. Cyprus, London, Alabama, Italy, Australia, Long Island, the Deep South, Dubai, European Union, Poland, Tennessee, North Carolina, Egypt, Scotland. Yeah, roll tide. I knew it was coming. It's all right. Yeah. Vietnam. Okay, now Amsterdam. Vegas. I can respect the Vegas. India. Hey. What's up, Nars? Liverpool. Hey. Look at the S&P 500 though. Break it down right now here, guys. Look at the S&P breakdown. Welcome here. Welcome. S&P all the way down to 6,700 right now. 6,700's on the S&P. It is falling as we speak here. Virginia. S&P falling down. Here's the NASDAQ here, guys. NASDAQ is dumping down too. NASDAQ at 24.8. 24.8. So the NASDAQ looking weak here. See if we hold ahead of this Fed meeting. We got 30 minutes left. 30 minutes left. You can see a timer in the top right. There is a timer in the top right, but man, I think with the PPI inflation fears this morning, markets are scared, to be honest here. I'm always watching your channel because you're all events are awesome. Hey, thank you, man. I appreciate it. Yeah, look, I see the NASDAQ breaking down. The Dow has not been in a good spot either here. Dow is currently at 46,000s here. It's at 46,838 right now. For the Dow, the S&P isn't looking much better though. At 6720s. And the NASDAQ has broken down a lot since early this morning. This is more conflict escalation. We got more news of strikes this morning. Oil, $97 a barrel, 97 a barrel for oil. Are you guys bullish or bearish? Chat. Bullish or bearish? I'm looking at the votes. 47% think hawkish. 22% think dovish. 31% think neutral for the Fed meeting today. So, yeah, I'll trade. Really, I think we're going to get chop ahead of the FOMC meeting. So, I'm watching NVIDIA, but I think we're going to get chop ahead of the meeting. So I think it's going to be virtually untradeable until afterwards. Like, here's a NVIDIA chart ahead of the FOMC. I think it's just not going to be super tradable. Bear for the rest of the day. Try to change it to sub-only mode. It automatically goes back to subscribers only mode. I'm waiting for the Cardinals to settle and then I'll trade. Yeah. All right, guys, we got the FOMC decision in 25 minutes. 25 minutes. NVIDIA's starting to rebound. I'm assuming this is driving the NASDAQ back up. Remember, at 2 p.m. Eastern Standard Time, we get the summary of economic projections. I'm not even in the stock market, but I watch you every day. 615, smart guy. Hey, thank you, Brian. I appreciate you, brother. Thank you, sir. If you're not in the stock market, what are you in? You know? But yeah, so we get the dot plot, which is the rate path, just to put this in perspective. Summary of economic projections and the dot plot. This happens every other meeting here, chat. So every other meeting we get this. In December, the dots were all over the place. 4 members projected no cuts this year in 2026. 4 projected 25 basis points. 4 projected 50 basis points in cuts. And Moran was the outlier, projecting 150 basis points of cuts. So the median landed at just one 25 basis point cut for 2026 during the last summary of economic projections dot plot. Today, the median dot is on, edge. There's a lot of people, specifically roughly 9 members projecting no cuts, or even some projecting a hike this year. And these are things that could move markets. There's 9 seeing at least 1 cut. Several analysts think the median could shift to 0 cuts in 2026, which is what a lot of the chat suggests here. Look at the NASDAQ rebound, though, ahead of this meeting. So the hike question, will we get rate hikes projections this year? Will we get Fed members voting for, I'm sorry, I have to change the song. I have to change the song. I just can't do that one. All right, here we go. So the Saudi Defense Ministry says they intercepted and destroyed 4 ballistic missiles aimed at Riyadh. Initial assessment shows no damage or injuries. So 4 ballistic missiles targeting Riyadh were intercepted. All right, but here we go, guys. We got roughly 25 minutes left. Will the summary of economic projections show rate hike outlook? Is the story. Most hawkish members like Hammock, Schmidt, and Logan are expected to project a rate hike this year. They're going to blame it on recent inflation data as confirmed of their views, like PPI inflation that we got this morning was elevated, and this doesn't even include the oil premiums that we're going to be seeing in the future CPI and inflation outlook. If Kashkari or Musalam join them in penciling in a hike, that's a major signal for a hike, even if the median doesn't move at all from where it was in January. So watch the dot count, how many dots are above the current rate, and that will be how many rate hike potential, that would be how many people are basically thinking that we'll get rate hikes during this. So the Iran war and oil shocks are going to be important. Deutsche expects the median headline PCE inflation projection to rise 2.7% and core PCE to go up to 2.6% for 2026, which are both up from the December projections. So again, Deutsche Bank expecting the median headline PCE projections to rise. I expect them to as well. I think with the oil prices that we're seeing going up, you know, that's what we're going to see, is we're going to see higher potential inflation. All right, guys, we got the Fomc decision going live very soon. Very soon. 20 plus minutes left. Is this going to be Powell's last interest rate decision? I don't think so. Honestly, I really don't think so. Doesn't Powell appear in one more in April? So don't we have another one in April? We had one in January. We have one in April. We have one today. But if we look at the CME watch tool, yeah, Powell steps down in May. And so if Powell steps down in May, we should still have the April meeting. You know, now I know there's rumors that Powell isn't going to be involved in this, but I don't know if I agree with that. Yeah, I just don't know if I agree with that. Powell can't quit. It's for the good of the nation. Long helium. The big thing to watch is heating oil, diesel, which is a big influence on inflation. Sooner you guys get rid of Nvidia as the most heavily weighted stock, the sooner the NASDAQ will normalize. Look at Bitcoin ahead of this meeting, though. Bitcoin is pushing up some ahead of this meeting. Look, here's Bitcoin right here. Bitcoin's seen at almost 72,000 right now. It's at 7170s, retracing some of these earlier losses that Bitcoin made ahead of this. Still, Bitcoin's down pretty significantly on the day here. I don't know why it always changes my time. But yeah, 71,700s right now for Bitcoin. So we'll see if that holds. But I think Powell has one more meeting after today. It's not just today. I think. You know. All right, guys. 20 minutes left. 20 minutes. Now, during the summary of economic projections, another thing that we're going to be looking at is GDP growth. GDP growth. So, if we look at this here, GDP growth are expected to be revised downward as well. And again, that makes sense because we've seen GDP drop from the last meeting here. So, if we look at some of this stuff, GDP is expected to be revised down December's projection was 2.3% real GDP growth for 2026. The February jobs report described as a train wreck, with payrolls falling by roughly 92,000 and unemployment climbing to 4.4%. This, combined with the Iran conflict and the inflation aspects of that, disrupting trade and oil, growth is clearly slowing, and there's worry about a stagflation signal. The Fed may raise inflation projections more significantly than it downgrades GDP, and so that's textbook setup for stagflation fears. December's projection had unemployment at a modest level, but with the February jobs report and ongoing stuff, we'll see if those get revised down as well here. But FOMC meeting is going to be at 2:30, remember. But we do get a summary of economic projections report here. So we do get a summary of economic projections SEP report. We'll see what we get here today, guys. We'll see. That's because Bitcoin doesn't take sides. Inflation is transitory? I don't know. I don't know, guys. We'll see. I'm going to try to take sub-only up mode off here during this report. Let me see if it shows up on your end, but I'm trying to take it off. So as long as it doesn't reset back to nothing here, which it kind of does sometimes, I think. Okay, yeah, there we go. It worked. All right, guys. NASDAQ still breaking down. Here's the S&P 500 ahead of this report. We have about 17 minutes left. 17 minutes. Yeah, good. For all my non-subscribers, try to chat right now. See if it lets you. I'm curious. I'm looking at other breaking news. Iran's Arachi spoke with the EU Foreign Affairs Chief Kallis. They discussed region, the Strait of Hormuz with Kallis. So, one of the Iran leaders is speaking with the European Union members. And yeah, we'll see what happens. This is TOS right here on the left side. This TOS right here is what I'm using. Thinkorswim, TD Ameritrade. But the reason we're probably going to have either a hawkish or a data-dependent Powell today is because of these premiums in oil. The last meeting we had was in January. And again, we can see when this conflict started. This conflict started here. So this conflict started here. This is the price of WTI crude. Brent crude is probably a little bit worse. But you can see how elevated oil is from when the last time we got one of these was. So you can see how elevated everything was from the last one. And yeah. We got Jerome Powell speaking. FOMC decision, guys. We're going to summarize here again. We're going to summarize all of it. We're going to summarize the FOMC decision. We're going to summarize the SEP summary of economic projections and the dot plot. And we're going to read the statement. The previous statement. Let's just take a look at what the previous statement showed here. So the previous statement from January showed up right here. And in the previous statement, it said, indicators suggest that the economy has actively been expanding at a solid pace. Job gains have remained low. Unemployment has shown some signs of stabilization. Inflation remains elevated. And so we paused rates during the last meeting. But this was the last statement here by the Federal Reserve. And so we'll see what we get today. But this is the last statement by the Fed. And yeah, again, we'll see if we have a similar tune to that now or what that looks like here. But that's the last statement by the Fed. Is that job gains remained low. Unemployment rate shown signs of stabilization. Inflation remains somewhat elevated. And so, yeah, that's what we got last time. Hey, what's up, Blaze? Is this going to be range trading? We're range trading leading into this right now. Like, if you look at a 1 minute chart here, markets are still moving some. But here's the NASDAQ. We're at 24,860s on the NQ. 24,860s. So NASDAQ is larger range. If we put up a 5 minute chart, we're basically sideways over the past 3-4 hours here in markets. Basically sideways. Rate hikes crash the stock market, destroy all traders' portfolios, and force them to go back to work. Yeah, I mean, I don't think the market necessarily wants high rates for longer, but I think the inflation aspects of this conflict are making people more nervous. So the inflation aspect of everything is making people nervous because of oil. And so if inflation continues to uptick, the war in Iran continues longer than expected, and we still continue to see problems in that regard, you know, that is a situation where we might have trouble. You know, we might have trouble. I don't know if we're going to get rate hikes. We're going to look at what the summary of economic projection says today. I don't know if we're going to get rate hikes or not this year, but I think it's a lot more probable than it was 2-3 weeks ago, prior to the Iran conflict. Prior to the Iran conflict, I would argue a rate cut today. You know, I don't think we're going to cut rates today, but it'd be much more of an argument. I think you'd have more justification for it. After the Iran conflict and all the drama going on right now, I think that's basically out the window now, and I think the big question is, do we get rate hikes at this point in time? So that's what I'm looking at. What to expect with the NASDAQ up or down, and why the decision making it go up or down. The decision is going to include a statement. All right, just to understand how you look at this, guys. The decision is going to include a statement. In the statement, it's going to tell us a brief review of outlook regarding the Federal Reserve. Basically, during the statement, they're going to say, hey, we paused rates, and this is why. And during that, they're going to say, hey, look, we paused rates because, you know, there's uncertainty surrounding things going on right now. Inflation is elevated. Jobs are weak. You know, because of the risk to both sides of the dual mandate, we're going to keep rates steady for a period of time. Is probably what they're going to say in this report. But at 2 p.m. as well, again, we are going to be getting a summary of economic projections at 2 p.m. So we're going to get a summary of economic projections at 2, and they're going to give us outlook on rate hikes, all that stuff. So we're going to get outlook on where the different Fed members voted in terms of where they think rates are going to go this year in 2026 and beyond, where they think PCE inflation is going to be in terms of projections, and more. So we're going to get some projections here in terms of what Fed members think we're going to get this year in terms of economic data, Fed path, rates, and more. So, you know, that is kind of the story. And Powell, there's rumors that Powell's going to step down. I don't know if he is, but there's rumors he is. So during the dot plot, it's going to show, does it hold rates at 1 cut, shift to 0 cuts this year, or worst case, shift towards rate hike odds for 2026. That's going to be a big priority to look for during this FOMC release. How many dots shows a hike? So even if the median holds, like even if the previous projections hold, basically, a cluster of hike dots is a signal that some members think we're going to get rate hikes this year. They're supposed to be revising PCE higher today as well. We'll see what that looks like, but they're supposed to be revising it higher. So anything over 2.8% core PCE for 2026 is rough. Looking at GDP, I think that's very relevant as well. But I think inflation risks are going to kind of balance in terms of GDP versus inflation risks. All right, guys, here we go. 10 minutes left. 10 minutes. Are you guys bullish or bearish on this report today? Let me know in chat right now. Are you bullish or bearish on this report? Remember, the big report is going to be the press conference with Jerome Powell at 2:30, but this one's not small. This one's not small. We got the summary of economic projections at 2 p.m. in 10 minutes. So yeah, we get the summary of economic projections at 2 p.m. and more. So it's not small. This is not a basic, really expected pause like we sometimes get. We're going to get economic projections considering inflation and more. All right, so looking at the votes, bearish, neutral, hawkish, bearish, bearish. Can't wait for cheap Solana again. Yeah, we'll see if we get it. All right, guys, 8 minutes left, 9 minutes left. So remember, Jerome Powell, it's the first time we're hearing from Jerome Powell. Jerome Powell, outside of the January press conference, we have not heard from him. He usually does speeches, you know, gives outlook on economic stuff. We haven't heard from him in months, really, since the January meeting. And so this is the first time we're really hearing from Jerome Powell in months. It will be interesting. I think it will be interesting. I see a lot of people saying bullish. My heart's pumping, hands itchy, money's coming in. Yeah, let's see what we get. Time for discounts. Jay Powell's going to drop the goodbye hammer with the word inflation. John, you got to give Powell some respect on not bending the knee. I mean, I don't even, you know, I'm kind of neutral on all that stuff. I'm not really going to go into it, but yeah. I don't necessarily disagree with everything Powell says or does. Like, I can agree with some of the stuff he does. It just depends. I think you could probably argue for some. I think you could have probably argued for rate cuts prior to this Iran conflict. Now, generally, remember, we don't really cut rates in the first half of the year most of the time. It's usually in the second half. Like last year, we cut rates 3 times. We went 25, 25, 25. This year, it's much more up in the air about how many rate cuts we're going to get just from everything going on. So, it's always bearish. Yeah, we can look at the dollar index here and see some interesting movement in the dollar index. It's at 99.80s right now on the Dixie. 99.80s. But the FOMC decision's here, and it's a really interesting time for it. Because Iran, conflicts, high PPI inflation. Earlier, PPI inflation showed up noticeably higher than expected, basically everywhere. Higher month-over-month headline, higher year-over-year headline, higher core headline, higher core month-over-month, higher core year-over-year inflation for PPI. And those can sometimes get passed on to consumers. And so this is not a small release here, guys. It's not a small release. JP, what's a good legacy on his way out? Hey, we'll see. All right, chat, 5 minutes. Let's get ready. Let's get ready. Be careful today. All right, the summary of economic projections. This could move markets drastically if we get rate. If we see some rate hike dots, that's where markets could get crazy. And so just be careful today. If we start getting rate cut odds, markets could really react to this. And so just be really, really careful. This is not a situation where you necessarily want to be trading right at 2 p.m. today in 5 minutes. Make sure you hit the live button next to the play button, put it in 2x speed. We appreciate it. Hit the live button next to the play button, put it in 2x speed. And yeah, we'll see what we get. But it's time. It's time. Yeah, I would just be really careful trading. I don't know. Powell's going to be speaking. Warsh is stepping in May, but Powell has 2 meetings left. He has today's and April's meeting. If the rumors aren't true and he doesn't end up stepping down. Dollar index is up a little bit on the day, and this is just because the conflict is causing more worry. The Trump administration is expected to soon lift summer gas prices to curb energy prices, apparently. That news just dropped, but we have 4.5 minutes left. It's time. Any chance that we get a dovish Powell today, guys? All right, here we go. We're going to get right into it. We have 4 minutes left. 4 minutes. Here we go, guys. FOMC decision coming very soon. Very soon, FOMC decision. Yeah, PPI inflation was for February. No, 100%. But this FOMC conference and meeting last 2 days, and this is where they get all this information. So Again, the big story, does it hold at 1 cut this year? Does it shift to 0 cuts? Or worst case, does it shift towards a rate hike odd in the dot plot? That's the number one story right now, leading into this in about 3.5 minutes. That's the number one story. Does it shift? Do we get a shift to 0 cuts? A shift towards a rate hike? How many dots show a hike? So even if the median outlook holds, a big cluster of hike dots, like basically a big cluster of people thinking we're going to get rate hikes this year, can be a huge negative signal in markets. So here's the S&P right here. It's at 6720s right now. And we're almost here, guys. We did have news just now that a U.S. official said that the United States did not target Iran's gas facilities, that the operation was carried out by Israel, apparently, according to some people. But all right, guys, 3 minutes left. 3 minutes left. All right, guys, summary of economic projections going live in 2 minutes. 2 minutes. So again, in a minute, I'm going to paste it. I'm going to summarize all of it for you live. And we'll see if the S&P and the NASDAQ moves here. But again, guys, we got about 2.5 minutes left. 2.5 minutes left. Here we go. 2 minutes. Bull or bear, guys? Give me your last minute predictions on this report. We're going to read the report in terms of the Fed statement. We're going to see what they say in the Fed statement, and then we're going to look at the summary of economic projections. But here we go. We are here. Chat, we are here. We have about 1.5 minutes left. About 1.5 minutes left. Bull, bear, bear, bull. Here we go. We have 1.5 minutes left, guys. Subscribe, hit the notification bell. We appreciate it. I'm showing bear, bull, bear, neutral, bear, bull, all the stuff. So, hey, we'll see what we get. We'll see what we get. Here we go. 1 minute. 1 minute. Super bear, slightly bullish. Yeah, we'll see today, guys. We'll see. All right, guys, 45 seconds left. 45 seconds. We got about 2,000 people here. We got 30 seconds left here. 30 seconds. I'm going to get this ready here, guys. Be ready. All right, 30 seconds. And here we go. 15 seconds. All right, guys, here we go. And here's the report in 5, 4, 3, 2, 1. And here's the release. Let's watch the market. Here's the S&P. Okay, so here's the Federal Reserve statement, guys. We have the Federal Reserve statement. Available indicators suggest that economic activity has been expanding at a solid pace. Job gains have remained low, and the unemployment rate has been little changed in recent months. Inflation remains elevated. They paused rates, just to put this in perspective. They're continuing to keep the at 3.5 to 3/4%. So they paused interest rates, number one. So that's number one. We did pause interest rates. But going into this, I told you guys we would. But the implications of developments in the Middle East for the U.S. economy are uncertainty. The committee is attentive to the risks of both sides of its mandate. As inflation remains elevated, job gains have remained low, unemployment has been little changed here. That's number one. All right, so that's number one. Now let's go to the summary of economic projections here and take a look at this. So again, we are going to go to the summary of economic projections page here and take a look. So stay tight. Yeah, so again, we're here. All right, so here's the projections. All right, we're digging into the summary of economic projections now, so stick around. We are digging into this now. And I'm going to summarize it here with Outlook first. So you can see the changes in real GDP here data. So you can see the changes. Let's take a look at the dot plot and see how many. And we do have some longer run higher numbers here for 2026. We do. I don't know if we have hike outlook for 2026. Let me see. So you can see the clusters here are a little bit more broad. So number one is I'm showing like a broad range of clusters in the summary of economic projections here. So for 2026, the median is 3.375, 3.375, or 3.4, unchanged for December, implies 125 basis point cut to 3.25% to 3.5% by the end of the year. The 27 median forecast is unchanged from December and one more cut, and the 28 is unchanged as well. The longer run neutral rate, they think is going to be at about 3.1%, which is upticked from 3% in December. In terms of the dot plot, so it's basically unchanged mostly here. So there's no dots above current levels. So the hike scenario some analysts feared did not materialize, which might be like a bullish sign. And so far, you can see in the NASDAQ here, 2.6 to 3.6% versus December's 2.1% to 3.9%. So the most dovish dot plot moved up from 2.1 to 2.6, which is Moran abandoning his 150 basis point call, to be honest. But when we continue to look at this, in terms of inflation, 2026 PCE inflation is up sharply from the 2.4% they were expecting in December. So that's a 30 basis point move upward revision. It's the biggest shift in the entire summary of economic projections is a little bit higher inflation. But we did not get a noticeable change here. We did not get a noticeable change in regards to the Fed's dot plot. Some analysts did fear that this was going to be there were going to be hike dots on the SEP, but so far we haven't seen that, and it's basically unchanged from December in terms of the dot plot and the federal funds rate path. Inflation up sharply, again, from 2.4% in December. It's now 2.7% outlook for PCE inflation. Core PCE is at 2.7% as well. This is up from 2.5% in December. The Fed now sees core inflation running much hotter this year as well. Previously, the range for 2026 in inflation was 2.2 to 3%. It's now 2.2 to 2.7%. So now some members see core PCE hitting 3%, which is ugly as well. In terms of GDP growth, it's up about 0.1% to 2.4% from December here. So I don't know. I mean, they're basically saying it's up slightly. Unemployment unchanged from December, slightly worse for 2027 at 4.3%. It was 4.2%. Unchanged for 2028 projections, longer run 4.2%. And the key takeaways is that this is a dovish surprise relative to expectations here. And markets haven't really moved much. Markets are moving upward a little bit here. And the reason markets are moving up, guys, is because we did not get rate hike outlook. So we did not get rate hike outlook. We're not seeing rate hike outlook. So again, we did not get rate hike outlook instead. And really, the outlook for rates stayed basically the same. Yeah, so the dot plot medium is moving slightly bullish short term, but the inflation revisions and neutral rate increases are structurally bearish for assets. So Powell's presser at 2:30 is going to be big. Again, stick around. We will be streaming the entire presser from Powell live at 2:30 p.m. Eastern Standard Time. So we'll see what Powell's got to say today. But what do you guys think? Was this hawkish or dovish? Markets reacted slightly positively to this report in the summary of economic projections. But again, unemployment unchanged for December for this year. 2027 slightly worse from 4.2 to 4.3% unemployment expected for 2027. 2028 was unchanged as well at 4.2%, and longer run was unchanged. GDP growth was revised up, not down, which is kind of a curveball here. GDP 2.4% up from 2.3% in December for 2026. 2027 GDP 2.3% up from 2%. GDP for 2028 2.1%, up from 1.9%, and longer run at 2%, up from 1.8%. Now, what I think this is going to mean here is that I think we're going to have hawkish Powell today. That's my guess from this report, is that we're going to have hawkish Powell today. We get 27 minutes left. But, yeah, I personally think we're going to have a hawkish Jerome Powell today. Again, we'll see what happens. We're going to stream the whole thing live. But I personally think we're going to have hawkish Jerome Powell today. And again, we'll see. Let me know what you guys think. Will Powell have a hawkish or dovish tone today? We did a poll of this earlier. 48% think we're going to have a hawkish tone. 48% think we're going to have a hawkish tone. We have some people betting neutral. I kind of maybe neutral as well. But with the GDP forecasts, we'll see. We'll see. Unemployment rate unchanged, basically. Slightly worse for 2027, but unchanged everywhere else. GDP, all of it was revised up. 2026 GDP revised up to 2.4% for economic projections, for up from 2.3 in December for this year. 2027 up from 2% is now at 2.3%, which is a big upward revision for next year's GDP. 2028 up from 1.9 to 2.1% this time. So they did revise GDP higher. But they also revised inflation higher as well, up sharply from 2.4 to 2.7% for PCE inflation. Core up from 2.5 to 2.7 in December. So big revisions there on those fronts. The SPY is kind of unchanged here. But yeah, the Fed pauses interest rates, guys. So the Fed paused rates as expected, which I told you guys we would. Looking at the bond market here, I see some people mentioning the bond market. So we can see how the bond market responds to this. But the bond market is actually reacting in somewhat of a dovish way to this. So like here's bonds. Bonds are actually falling down. We're at 4.21% right now. So bonds actually fell down a little bit here. So interesting. We'll see if this holds, but man, bond price is dumping a little bit after this report. The bond markets might think this is dovish. So interesting. Again, I think the statement, it had risk to both sides. So I think the statement had risk to both sides here. But we'll see what happens, guys. We'll see what happens. But the statement showed risk to both sides. Let me see if I can... Yeah, look at yields fall down here, guys. So yields at 4.21%. Now, stick around. We are going to stream the entire FOMC press conference live. So we will be streaming this live. And stick around. Here, I'll put this up on screen. Let me get this ready. But NASDAQ is reacting well to this. The NASDAQ is reacting well. Also, do me a favor, hit that subscribe button, hit the notification bell. Help me hit help me hit 100, what is it? What am I at now? 170,000 subscribers? Hey, help me hit it right now. We appreciate it. We're going to get this tune ready here for you guys. But here, let me put this up so you can see charts as well. So we're going to get this up so we can see charts and this FOMC decision. Yeah, so I'm going to switch this to full screen. But yeah, what do you guys think about the Fed meeting? Again, I see a lot of people saying crypto is dead. Looking at the NASDAQ is dipping back down after going up today. But we have the FOMC decision live at 8:30. I'm sorry, at 2 p.m. Eastern Standard Time today. 2 p.m. FOMC decision. So we will see what we get today, guys. But 2 p.m. Eastern Standard Time. Or 2:30. I don't know why I keep saying the wrong time. IT companies are having layoffs. Yeah, what will happen to gold? I really don't know here. I really don't know. If we take a look at gold, let me see what gold's doing right now. Gold has had a bad day, but it did start to rebound since I last looked at it this morning. So again, summary of economic projections dot plot update showing fear. But GDP strong, high inflation. So I think we're gonna get a hawkish Powell today. I think. So we will see what we get, but yeah. Fed pulse rates. So what do you think about oil? Yeah, I think oil is going to cause inflation worries. I think Powell's going to be hawkish today, personally. Oil dipping back down, though. So look at oil. Oil's now technically red on the day, so that's a good sign. That is a good sign. Yeah. Yeah, so Fed held rates 11-1 vote. Moran dissented, though. So we did have Moran dissenting again during this FOMC meeting. So last time we had, what was it? Moran and Waller? Or was it Bowman that dissented last time? Let me look at the top of my screen. I can see it at the top of my screen. All right, guys. But yeah, we have 18 minutes left. Yeah, Moran's going to be dissenting. He was the newest appointee by Trump, and so he's going to be dovish, you know. That's as expected. Yeah. Again, look at oil, though. Oil dipping down here. Let's see what we get, but... Yeah, Moran's dissented every time. Yeah. We'll see what Moran does next time, but he's dissented every single time at this point. Yeah, we are waiting for this FOMC decision here, though. Or we are waiting for the press conference. Jerome Powell's tone is going to be what moves markets here. So Jerome Powell's tone during this FOMC press conference at 2:30 in 16 minutes is going to be a bigger market mover than what we have. We had the summary of economic projections. It was interesting. But what Jerome Powell says during the speech is going to be what moves markets. Like, don't get me wrong. Like, what he says during the speech is going to be what moves things. And yeah, we'll see. We'll see what he says. But, yeah. Again, we have 15 minutes left. 15 minutes left. Yeah, we're now waiting for this this to start here. I'll put this up on screen so you can see it. Maybe I could lower it some. What's oil chart doing? Oil is breaking down some here. If somebody is asking for a timer, look in the... Yeah, here. Look at the right side of the screen, my friend. Oh, wait. You can't. Sorry, I'm on the big screen. My bad. Yeah, let me make myself smaller here. I got you guys. Hold on. I'm trying to get this set up here, so we're going to have it set up. All right, guys. FOMC decision, 14 minutes. 14 minutes. What color will Powell's tie be? Will Powell have a red or green tie today? Let me know. I don't know. I think Powell's going to have a purple tie. A mauve tie. Is it mauve or mauve? I don't know what it is. What color will Powell's tie be? It's usually purple. I think he picks purple because it's somewhere in between. But generally it's purple. Here, let me put another chart up. So people are asking me what oil is doing right now. Let's take a look at oil. There's oil on the bottom chart. You can kind of see it still. What is that, Nike? We'll put this up like this. It's the S&P right now. So summary of economic projections, upward revisions to inflation and upward revisions to GDP is what we're seeing here. So higher inflation projections, higher GDP projections. I think we're getting hawkish Powell today in about 14 minutes, 13 minutes. You can vote on the poll. We got about 1,500 votes. 48% think hawkish Powell as well. So almost half the votes out of 3 different options voted for hawkish Powell. And I agree. I think it's going to be hawkish or neutral. I find it very hard to believe Powell is going to be dovish today. Just because dovishness means low interest rate pushing Powell, like fearing job weakness Powell. And I just don't think we're getting that. I don't think we're getting all that is going to stress the labor market fears heavily. I think it's more so we're going to get a Powell that stresses the inflation risks, and that's going to mean less rate cut potentially. And, you know, really data dependent Powell makes sense as well. But we'll see. We're almost here. Red. I don't think Powell's wearing a red tie. He's just not going to, you know. So Powell's not going to be, you know, yeah, he's just not going to. All right, guys, we are waiting. Crypto will react. Yeah, what's Bitcoin doing? Bitcoin down to 71 885s. 71 885s. Green for St. Patrick's Day. Yeah. We're here, guys. We're here. Again, hit that subscribe button, hit the notification bell. Let me know where you guys are from in the chat. Where are you guys from? We have 12 minutes left until the FOMC press conference. We did this earlier. We had a lot of like people outside the US. I was surprised at how many people are outside the US. Maybe they're just chat more. But yeah, we got the FOMC press conference going live today in about 10 minutes. About 10 minutes, a little bit less than that. Yeah, I'm looking at Jersey, Chicago, Pakistan, Czech, Denmark, Miami, Detroit, Taiwan, South Africa. Not a bot from the European Union. What's up, Knight? Cuba, Singapore, Hong Kong. Hey. All right. I don't know why this channel only has 169 subs. 170 if we get it today. But 169, you know. All right. Let's get ready for hawkish Powell. I'm preparing myself for hawkish Powell today, really. So I'm trying to mentally prepare myself for a hawkish Jerome Powell today. We will see, but yeah, I mean, we have 170,000 subscribers, just to put it into perspective. I was just kind of joking. But yeah, so the FOMC maintained rates as expected. No change to forward guidance sentence on extent of additional adjustments or the commitment to maximum employment and 2% inflation. The only dissent we saw was from Iran, who's going to dissent. Iran's going to be a dissenter here. This is widely expected here at this point in time from Iran. He's going to be dissenting here. But most attention is going to turn to what Jerome Powell says during this event. So what Powell says during this event is going to be the key factor here. We have 9 minutes left. 9 minutes. We get the overlay out. Get the countdown down. I'm going to zoom in so you guys have a much larger view of the Fed meeting here. So give me a second. I'm trying to... Remember, guys, I am not an investment professional. We are not liable if you lose money. Always make your own assessment. Trade responsibly, guys. We don't do any financial advice here. That's not what we do. There we go. Okay, I'm trying to zoom in so you guys can see this cleaner here. Do we want a little bit smaller than that? Probably. Maybe a little bit larger. Yeah, there we go. I think that's good. We can look at the NASDAQ here on the right side. We can get this box out the way too. We got Bitcoin's chart up here, but I'm going to put the NASDAQ higher here. Here's the NASDAQ. NASDAQ is starting to flush down a little bit. We'll see what he says. This is actually a little bit too large. Let me reduce the size here, actually. There we go. Squeeze it over to the side here. Make this a little bit bigger. I think that's pretty good, right? I'll put myself in the corner over here. All right, guys. So again, Fed keeps rates unchanged, as expected. We have 7 minutes left here. 7 minutes left. John, thanks for putting the time in. I remember when you hit 100,000 subscribers. Hey, thank you, my friend. I appreciate it, brother. Yeah, I mean, one of the things we're seeing here is that oil spiking up. Like, people ask me what I wanted for rates. Like, would I cut rates today? Maybe if it was prior to the Iran conflict, sure. I could probably argue a rate cut. If it was prior to the Iran conflict, probably. The problem is that the Iran conflict spikes the price of oil so much, and that means future inflation. Even if the conflict ends tomorrow, we're still going to have noticeable damage to infrastructure, noticeable damage, and noticeable increases to the price of oil for the foreseeable future. And so if the conflict didn't happen, maybe I'd argue a small 25 basis point rate cut today, because rate cuts don't really spike inflation in any huge way most of the time. Quantitative easing does. QE definitely can. But rate cuts generally are pretty mild in terms of, as long as they're small. But again, with this rate, or with the Iran conflict spiking the price of oil and making inflation worries more profound, I think that makes it a little bit different of a situation here. So that's kind of where I'm at with it. But as long as oil's high, I just don't think we have as much of a green light to cut interest rates. And I don't think this is like a crazy thing here. I think this is pretty obvious. I think it's obvious that with oil prices being this high, we're probably going to be dealing with some inflation moving forward. All right, guys, here we go. We got the FOMC decision going live now soon, or the FOMC press conference with Jerome Powell. We'll see what this looks like here, chat. We will see. But yeah. We'll see what the speech shows. An interesting thing here, guys, is yields. Yields. Let me get the music back on. Yields actually dropped a little bit from this report here. If you look at yields real quick. Look at yields. So yields down to 4.21% right now. Here's 2 p.m. when the report came out right here. And look at yields decreasing. So yields actually went down a little bit on this report. I don't know. I think what this report showed is upward revisions to inflation, upward revisions to GDP, which is kind of the curveball. Like the shocker here is the upward revisions to GDP. Those upward revisions make things a little bit sketchier right now, for sure. So those upward revisions definitely make things a little bit sketchier in terms of rate cuts. But markets so far have been mostly unchanged. Like, I haven't seen the markets react this little to an FOMC decision in a while. And so, yeah, it's kind of interesting, But we'll see what Jerome Powell's got to say here. I'll move myself over here. But this is in 4 minutes left. 4 minutes. All right, guys. So again, this is going to be starting in 4 minutes, a little bit less than that now. Hawkish or dovish Powell is the only question left, I think, with this starting here. 3 minutes. Yeah, I don't know if it's Powell's last FOMC meeting. He's supposed to have another one in April. There's been rumors of Powell. Like, you know how many rumors we've heard about Powell stepping down, about Powell getting fired over the last 2 years? Now we're a couple months away from May. It's looking very unlikely that the FOMC or that Powell is fired. It could happen. It's just not super probable. It's not like the odds are pretty freaking low. Pretty freaking low. So we'll see. But again, the odds are kind of low, I think, right now. Yeah, they recently had a subpoena against Jerome Powell from the Department of Justice is who the subpoena was from. So this subpoena was from the Department of Justice. And so, yeah, again, it was from the Department of Justice. It was recently dropped by a judge, though. So it wasn't like... They're going to try to appeal it, I'm guessing. But it was recently... It was recently dropped by a judge, so... Alright, here we go, guys. Here we go. Yeah, we did have 9-1 on the voting lines, though. 9-1. Moran was the only dissenter. I think it was 9-1, right? Or 11-1, I'm sorry. Let me put this up in big yellow letters so you guys can actually track it here. Alright, there we go. Alright, guys, we got a minute and a half left. 1.5 minutes. I think they got a subpoena, but it was dropped. I don't think we should have gone after him in the first place. I think it's just too much. I think, I do think it's political pressure to try to get him to lower interest rates. And to a certain extent, prior to the Iran conflict, I agreed that we maybe should have been cutting interest rates considering the weakness in the labor market. So I'm kind of in the middle somewhere. People that are super dovish don't really like my opinion about it, and people that are super hawkish don't really like my opinion about it. I think there's risks to both sides, and a lot of people would argue stagflation right now, and I'm not even necessarily against that. So, all right, guys, 30 seconds left. 30 seconds. We do have MU earnings going live after the closing bell today as well. All right, I'm going to turn the music off so we can get this going right. And we're also going to turn this up. I'm going to turn the music off. And we're going to make sure the desktop audio is loud and crisp here for you guys. You're welcome. That's what we do. Okay, here we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. From last September through December, we lowered our policy rate 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time, and that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between a half and three-quarters, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the SEP, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially it is that, the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods and on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
That consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending spending there. They can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction that to your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down, and we don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement, and also what you've written down before you'll be reluctant to move too far away from that just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past.
Yeah. So there'll be an offset.
Offsets, yeah.
So that's true. We're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable, and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period of time, meaningfully higher. So I wouldn't say there's much of that happening. Not much of it happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that having looked through tariff inflation and inflation running above target and looking through the oil price shock would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision-making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had, we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can can cause trouble for inflation expectations. And so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And I think it's important that we do that. Very important.
Nick.
Nick Timoros, Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well, as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months a year to go through the system, and we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system, so that goods inflation will return closer to what it's always been. I mean, it used to be for many, many years it was negative, and then the year before tariffs came in, it was 0, and it's running at like 2% now. So, and so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now is just kind of on that borderline, the higher borderline of restrictive versus not restrictive. We feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services. But we're not seeing progress there. So we do, what we expect for next year is what we want to see for this year, rather, is continued progress on housing services, finally seeing that the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Edward.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can. We're at 3.0% core. inflation 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time. And that's a concern. We need to get back down to 2%. And we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard-pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet, and I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply-side story, has changed despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. In a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent, really, growth in the labor force, which, of course, we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now, that's balance, okay, but I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So, we look at that, we see it, we get it, and I mean, everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless, it's something we're watching carefully, and are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless, something we watch carefully.
Andrew. Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank need to start taking account of the risk of supply shocks as a more common problem?
You know, we did go through a long period where the shocks were all demand shocks, and so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure. And it's just a very different thing and a very much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But, has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but I guess, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The possibility that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case, and of course we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Maria Luisa.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business services as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you know, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of, you know, of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that you know, we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were like discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there is tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. You know, when we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's, you know, 1 percentage point above that. So calling that stagflation, it's not, you know, I would reserve the term stagflation for, you know, a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean, because honestly that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting, and usually we do, but in this case we're going to learn a lot, because we're going to learn 6 weeks to the day till the next meeting, and we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves with what happens in the Middle East. That's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023 when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year, they should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I mean, I think that the theory is probably right, but as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. So I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing is, our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history, and then they've built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc. And for all the tariffs, they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases. And we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision. But the administration said they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Chris Rugaber. Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year?
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's your opinion at a moment in time, which can change based on events. Sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction, and so I just think we do it. And I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think, but we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one though, I think it's even more than usual good to take the forecast with a grain of salt because subject to just very high levels of uncertainty.
Brian.
Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, there were big price increases all around the world, by the way, everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet, and it will take some years of positive, real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed, and there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing, and what it does for us is makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and stable prices is half of our mandate. It's one of our two mandates, maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States, anywhere in the world, in a market economy, in a democracy, and you'll see, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Richard.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or specific answer on the first question. We're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. In terms of diesel prices. So your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, the cost of food and other goods that really rely on it to
So
move
I think
across the country.
it's a more general concern than that. It's diesel prices because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many, many things. So, and those there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that and we're watching it, but we're right at the beginning of this, and we don't know how big we just don't know how big this will be and how long it lasts. It may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Archie, for the last question.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP and noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. We actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity, and by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So it's quite unusual, and it's this is the higher productivity is the thing that allows incomes to rise over time, and so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that, and just briefly on that as well to finish up. You hear the argument a lot, this is a sort of disinflationary story, and if you believe that productivity thing, that should also weigh down on inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really is the demand growing faster or slower than the supply side, and I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
Okay, guys, so that is the end of Jerome Powell's press conference. Just to summarize all of this stuff real quick. Number one, let's take a look at the NASDAQ. The NASDAQ overall, I would say, has negatively reacted to Powell's speech. Now, Powell did stress a lot of stuff in the speech. He said, let's talk about it. So regarding rate decision, he said the economy is expanding at a solid pace. Inflation remains somewhat elevated. Policy stance is appropriate. A lot of stuff was unchanged from the last meeting. The median dot plot was held at 1 cut, which is what it was in December. But he did say there was a meaningful move towards fewer rate cuts. He also said if progress on inflation is not seen, there will be no rate cuts this year, is what he means by that. The vast majority of participants do not see a rate hike as the next base case. And so we're probably not getting rate hikes. Honestly, this is kind of what I said before, which is that I don't think we're getting rate hikes this year. I don't think we're getting that many cuts either. He said the Fed is in a difficult situation that must balance risk to both sides. Inflation has been above target for years. Regarding inflation, he says you worry an energy shock could unanchor expectations. He said inflation overshoot mainly from goods and tariffs. He said non-housing services inflation is frustrating, which is what we saw in the PPI report this morning, which is, services inflation causing most of the spikes in PPI wholesale inflation this morning, and not seeing progress there. Short-term inflation expectations have risen, but long-term expectations are still solid, and that the Fed is strongly committed to keeping inflation at 2%. Of course they are. And regarding tariffs, he said waiting for tariff pass-through to work is a way through the economy. He's not certain tariffs will be a one-time effect, though, not at all certain, and that the theory says it should be one-time, but timing is uncertain. He said slightly more confident tariff inflation comes down mid-year, and that the oil and Iran conflict is part of the oil shock that's baked into the higher inflation forecast. So they did take the oil shocks from the conflict into the forecast. He said no one knows the impact the Middle East conflict could start. Energy supply shock is a one-time thing in theory, but that he hopes gas prices increase is not prolonged and won't speculate on outcomes. If there was ever a meeting to skip the summary of economic projections, he said this would have been a good one to skip. Basically saying there's too much uncertainty and variance in outlook is what he's saying. Because of the situation in the Middle East, we don't know how long it's lasting, just to put that into perspective. Now, regarding growth in the labor market, he did say growth upgrade driven by growing confidence and productivity. But the current rate is the higher end of neutral or mildly restrictive, but it's borderline. He said disinflation is not coming from restrictive policy, and if his successor Walsh is not confirmed before his term expires, he would serve as chairman pro tem. Yeah, so in the background, Qatar Energy did confirm missile attacks on Ras Laffan Industrial City and more. But yeah, that is the rate decision today. Markets are mostly negative responding to this. And yeah, we'll see what we get here, guys. We'll see what we get. We do have the FOMC reaction tomorrow. So tomorrow we are going to get some interesting stuff. We do have jobless claims job report going live at 8:30 tomorrow. And yeah, we'll see if it holds here, guys. We'll see if it holds. But yeah, jobless claims job report at 8:30 tomorrow morning. And see what happens here. We'll see what happens with it. But it's a scary market, honestly, right now. There's a lot of fears. FOMC meeting did not have a positive reaction. And before I cut out of here, guys, so before I cut out, if you want to help support the channel, everything we do here is free. I appreciate the love. And look at the NASDAQ break lows right after this FOMC decision and meeting. So, but yeah, if you want to help support the channel, check out Lucid Trading, guys. Lucid Trading, there's two platforms you want to check out. Number one, Lucid has some of the most relaxed rules in the game. If you want to day trade, do not fund your own account thousands of dollars trying to look cool. You'll probably lose. Most day traders lose money, and I am not an investment professional. I am not liable if you lose. Some of these links are affiliate links. Nothing here is financial advice, of course. But don't fund your own account thousands of dollars. Most day traders lose. And so if you do that, you're probably going to lose money. Instead, you can try this. You can get direct-to-funded option on Lucid as well. Lucid has end-of-day drawdown, 10-to-1 microscaling, no hard breach rules, 90-10 profit split, no payout windows, some of the most relaxed rules in the game. And you can also go direct-to-funded. If you use my coupon code, you get it for $94. I think you get 50% off if it's your first couple of times. If you go to Lucid Direct, which is direct-to-funded, you get it for $238 with my coupon code BT at checkout. It's a great way to help support the channel. I will put the link up here. And yeah, y'all just be careful here. Guys, y'all just be careful. Again, jobless claims unemployment tomorrow. Another firm, if you want to check them out, is Apex. Apex has the cheapest accounts in the game. They got rid of their end-of-day drawdown rule, no payout denials, no MAE rule, and more. So if you want to check them out, again, I'll put the link up. Great way to help support the channel. And yeah, we'll see what happens. Here's the Lucid link. Again, cheapest accounts in Apex. But if you want to check out Lucid, BT is my coupon code. Apex, same thing. BT is the coupon code. But this has some of the cheapest funds. So if you want cheap accounts, if you use the intraday drawdown at $17.70, if you use my coupon code. If you want the end-of-day, the base one, again, is like $27, $26. BT, coupon code BT. Again, the sale ends in about a day. So I'll put that link up as well if you want to help support the channel. There's the link in for Lucid. There's the link for Apex. And I'll see you guys later. Y'all be good. Have a great day. Be safe in these markets, guys. I will see you guys tomorrow. So we do have stuff going on tomorrow. Be ready. Jobless claims unemployment drops live at 8:30 Eastern Standard Time tomorrow, guys. 8:30. Eastern Standard Time tomorrow. We do get jobless claims unemployment filings going live 8:30. We'll see what that looks like. And yeah, not that much hype for this FOMC decision, but to be honest, we'll see what the market does tomorrow, really, because again, market so far has not reacted well to this. Yeah, we did not get a good reaction to this so far. Yeah, we cannot get a good reaction. And yeah, so as soon as I close this stream, it will bring you to tomorrow's stream if you want to help support the channel. I'll redirect everybody to that now. And yeah, y'all be good. Have a great day. Be safe in markets, guys. Be safe. Coupon code BT. and get out of here. Y'all